Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Tariffs blocked. A U.S. court strikes down most of President Trump's levies as illegal. The White House says it will appeal. And the AI boom continues. Nvidia calms investor fears over a China slowdown with a solid forecast.
These AI services.
And our exclusive interview with PIMCO President Christian Stracke just around the corner. Now, in the meantime, we wanted to play you some sound there from both the Nvidia CEO and President Trump, because those are the two stories dominating. We thought maybe it'd be Nvidia to start the morning, but not so. It is this overruling of President Trump's, at least Trump 2.0, his tariffs. That has sent us off to the races. We're up 1.5% for your S&P 500 futures. NASDAQ up nearly 2%. I got to say, maybe not as big of gains as you would expect, but we are now only 4% away from all-time highs. When it comes to this bond market, interestingly, yields are still higher across the curve. You can see the long end. We closed above 5% for the first time since October 2023. Maybe if we don't get that tariff revenue, maybe you can't have as glorious as cuts. You can't have the big, beautiful bill. That seems to be weighing on investor minds this morning. I should note the dollar also finally stronger. Do we start to price out some of the policy volatility with this latest ruling? We'll get more into it, but first, let's get you some stocks to watch this morning. With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So big moves in the chip space today. We are seeing Nvidia rising at around 5% in the pre-market. Remember, the sales beating expectations pretty much due to sales of the H2O chip. In fact, better than feared, given the restrictions we've seen on China. That was kind of the main takeaway. The Blackwell chip ramping up, of course, I can't forget that one. And we're seeing a feed through into peers. Marvel Technology, Supermicro, ARM, all of the chip stocks boosted by that single report in the pre-market today. But a stock not boosted is HP over in your computer hardware and printers. That one hit hard in the pre-market this morning. The company actually missing expectations on their earnings by around 10 cents, well below analyst expectations. So HP down at around 9% this morning. Then one for the believers, Hailey Bieber offloading her company to e.l.f. Beauty. Now that is worth around $1 billion. I've spent the morning learning all about cosmetics. I've learned that e.l.f. stands for eyes, lips and face. So I'm learning all the time on this one. But that stock, e.l.f., gaining 8%. News on that M&A deal actually taking the shine away from a weak earnings report from e.l.f. this morning. Danny, keep an eye on that one and check out the before the bell opening wrap on the terminal very soon for you this morning, Danny.
We all learned something this morning, Joe. I did not know that either. Thank you very much for that. Bloomberg's Joe Easton. Now, in just a few moments, we're going to be speaking exclusively with PIMCO President Christian Stracke on the state of credit. Later in the hour, we'll also be catching up with Julian, Emanuel of Evercore ISI to talk about where stocks go from here after the latest court ruling, and Frank Lee of HSBC on Nvidia earnings. Let's get back to our top story, though. The Trump administration has been given 10 days to lift almost all of its global tariffs after a U.S. trade court deemed them as illegal. The Justice Department has already filed a notice of appeal. For more, we're joined by Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, help us understand exactly where do we stand now with Trump's tariffs?
Yeah, so this is a pretty big setback for the Trump administration. The White House had basically based its entire economic agenda on the foundation that tariffs would bring jobs back to the U.S., would bring production back to the U.S., and the particular tariff that the president launched on April 2nd, this so-called reciprocal tariff, was the biggest, bluntest instrument he was going to use, and it worked. It got countries to come to the negotiating table. There are, by a couple of estimates, a dozen or two countries that are negotiating bilateral trade agreements with the United States right now. This court ruling throws all of that into question. Why would a country continue those negotiations if the reciprocal tariff that the administration is hanging over their heads is illegal and won't be imposed? So there's a lot of questions, way more questions than answers right now. We should get more as the day unfolds. One of the big ones is, will Trump comply with this court ruling? They as you mentioned, they're going to appeal. But Trump has tried to stretch the use of his authority in other cases, and he's done so in this instance, apparently, according to this court. So the administration will be watching closely as to how the administration shifts now into its Plan B. It's not the only tool that's been taken away from him to conduct trade wars. There are many others. So trade wars aren't going away, but they might be on pause for the next couple weeks.
Hey, Brendan, thank you so much for that update. A lot to unpack. That is Bloomberg's Brendan Murray. I'm pleased to say that joining us now for an exclusive interview is Christian Stracke, President and Global Head of Credit Research at PIMCO. Christian, what a morning. Who knew that this is what we'd be talking about to start? But we really have this year been oscillating between bearish and bullish, fears of trade, fears of fiscal deficits. Where do we stand now? Is this a bullish trade with this ruling in hand, a wave that you want to ride right now?
Yeah, thanks. It is quite a morning, and certainly quite a last few weeks. But really, there's a few moving pieces right now that are driving what's happening in markets. On the one hand, if you have tariffs getting rolled back, then that could mean less inflation than the market had been pricing in over the course of this year as a response to tariffs, which then would maybe, at the margin, help the Fed be a little more confident that it could start a rate-cutting cycle. On the other hand, if all else equal, people were thinking that tariffs and a trade war would dampen economic sentiment and dampen economic growth, then if you have less in the form of tariffs, then maybe you have more economic growth, which then maybe gives the Fed more pause. So basically what you're seeing in the market is a little bit of higher rates today on balance, not much. Market being in the fixed income market pretty well behaved through all of this. And then, of course, an eye on what happened with the Nvidia earnings and how that helps support equity prices, which in turn helps the economy more broadly. So all in all, it makes a little bit of sense that we've got rates a little bit higher here. But generally speaking, the market is digesting this news pretty well, as it has been for the last few weeks.
To that point, Christian, one of the big left tail risks for this market had been the fact that you could have a president who could put out a Truth Social post, who could, with the press of a button, implement tariffs and send markets in that volatility spiral. If we remove that tail risk with this court ruling, does it make us reconsider what had been a waning U.S. exceptionalism trade? Do U.S. assets all of a sudden look that much more attractive?
Well, I mean, it's early days, of course, in terms of the battle in the courts around tariffs. So it's hard to say that the volatility related to tariff announcements is over. But I think the market, even before today, the market has been saying that the world can digest the changes in tariffs as they stood before this court decision, and the world can even digest and handle the volatility around the Truth Social announcements. That's why you've started to see stability in fixed income markets. That's why you've started to see stability in credit and equity markets. Now, there will be more headlines and there will be more volatility on this back and forth in the courts or on the tariff announcements. But I think the market has been sending a pretty positive and healthy signal that, yes, there's volatility, yes, there's uncertainty, but by and large, we can settle in around what is a base case of weaker growth, a little bit higher inflation, but neither alarmingly so.
You're painting quite a benign picture, Christian. We had heard from a lot of companies, though, that had really hit the pause button when it comes to things like hiring, when it comes to capital expenditures. For borrowers at this moment, how challenged are they? Just how disrupted is the normal business model for funding and liquidity?
Yeah, it's a great question. It's really a kind of differentiated across different borrowers. If you look at large cap investment grade companies right now, they're in a good place. They had years ago termed out their debt with low fixed coupon rate debt, and they are pretty well set up for if there is economic weakness. Now, certainly what we hear from most of the large cap companies that we lend to at PIMCO, that there is a pause and a lot of fixed investment waiting to see what will happen with not just the tariffs, but also tax policy. So that pause is real, and it will dampen growth over the course of this year. But by and large, those companies can manage. Where there is more concern is lower down in the capital structure, particularly those below investment grade companies that have borrowed in floating rate liabilities, so bank loans in the bank loan market and also the private credit market, where you do have a lot of companies that pay floating rate debt, and rates are much higher than people had expected today and will be much higher than people had expected over the course of this year. And so the weight of those interest costs is pretty serious on what are already pretty levered companies in the context of an uncertain economic outlook. So you are seeing a moderate but real default cycle emerging in that part of the credit universe, that leveraged loan, bank loan space, and private credit. So far, it's pretty manageable, and so far, it's not anything that is seriously concerning for the rest of the system, but it is something that we're keeping a close eye on.
What are the risks it becomes unmanageable, that it becomes concerning for the rest of the system, Christian?
Yeah, well, you'd really need a hard recession. That's what it'll take. So in a scenario, which is PIMCO's scenario of weaker growth, low growth this year, but not a recession being the base case, then you'll see kind of a mid-single digits type of default rate in that leveraged loan space, in that private credit space. And that's difficult. It'll be worse than seen in years prior, but something that will be okay. If you had a hard recession, then that's a difficult world for a lot of those companies to manage through, where you've got the Fed still on hold or will be slower than it would otherwise be, and economic weakness. Then you could see a high single-digit default rate in that space. Now, how that then would trickle out into the rest of the economy is difficult to see. Banks are in a pretty good position. I think one factor that has given us a lot of confidence over the last 2 months has been that if you look at bank equities, bank spreads, they've been pretty well behaved through all of this volatility, which speaks for banks as a turbocharger of volatility, as a channel of weakness, are not as concerning as they might have been in prior years, because banks have done a lot to delever and banks have done a lot to recapitalize. And so given that, we're less concerned about a systemic shock to the system if we did have that worse than expected economic scenario.
One place that we have seen continued volatility, Christian, is in sovereign bond markets. It's not just happening in the U.S., it's happening in the UK, it's happening in Japan. But here we had 5-year yields close above 5%. There's serious concern about fiscal overhang and what that could mean for the bond market. Is there a structural rethink happening more widely in bond markets, Christian? Do you look at treasuries and say, these aren't the risk-free assets that they once were?
Well, there's a few things going on, and one is just as basic as portfolio rebalancing. A lot of investors, a lot of PIMCO's investors, see that they have much more exposure to the U.S. and to dollar assets than they had expected, and part of that is just the natural creep of U.S. strength and U.S. exceptionalism that we'd seen in over the last couple of years has left people more exposed to the U.S. And so there's a rebalancing, there's a pullback and back into more home bias currencies, away from the U.S. into the euro, into sterling, into yen, et cetera. As that happens, that involves selling of U.S. assets, and that involves selling of U.S. fixed income assets, and that's led to some of the volatility that we've seen. That'll take some time to happen. It's not particularly alarming. What is a little more concerning, though, is more what you mentioned, the fiscal exhaustion. Are there limits to fiscal deficits in the U.S. and in the developed economies, and limits to how far markets will finance those deficits? And there is certainly, that question is an overhang. And one of the open questions now will be if the market had priced in some amount of revenue coming in from tariffs to help to finance, maybe not explicitly, but implicitly to finance the tax policy changes that we're seeing coming out of the Trump administration, then if that tariff revenue goes away, does that compound issues around the deficit, around the Treasury's ability to finance itself? So that will continue to drive volatility in the coming months as markets look to see some resolution, both on the tax policy but also on tariffs and whether they help to finance.
It's such an excellent point, Christian. We're certainly seeing some degree of that play out this morning. And you have seen some other governments, the UK and Japan, take a note of the US's book, that is, pull back on long-term debt issuance. It's something you usually see in emerging markets, of buyers unwilling to buy long-dated bonds. What is the likelihood we get to a situation where you have a fiscal deficit in the U.S. that buyers, especially foreign buyers, to your point, are less likely to fund?
Well, you could say that over the last several weeks, there's been some of that already. There's been some change in portfolio allocation where foreign buyers are saying, we'd prefer to be in our home currencies. We'd prefer to be more diversified and away from the U.S. And so that will drive outcomes in markets in the U.S. It'll drive outcomes in policy as well. And so, there's real focus on this in Washington on the part of policymakers in terms of keeping an eye on the bond market, keeping an eye on what is possible in terms of tax changes, what is possible in terms of tariffs to help to stabilize the Treasury market. By and large, though, you can look at the last couple of weeks and see that there has been some stability and some realization that this will be painful and this will be volatile. But it won't be something that gets out of control. It'll be a process over the course of this year and probably into next year of rebalancing these portfolios that will keep pressure at the long end of the curve. And for that reason, PIMCO portfolios are underweight at the long end of the curve. But it should be something that should be reasonably manageable, barring any alarming changes on tax policy or on tariffs.
Christian, I'm pleased to say that you're sticking around with us. Much more to cover. Christian Stracke there of PIMCO. Let's first get you some other stories that are trending on the terminal this morning. The Trump administration is moving to restrict the sale of chip design software to China. Bloomberg sources say the Commerce Department sent letters to some of the leading providers of electronic design automation on Friday, telling them to halt shipments to Chinese customers. Shares in top makers of the tech like Cadence Design Systems and Synopsys are falling in the pre-market trade. Every Doge has its day. Elon Musk's time as a special government employee is coming to an end. The billionaire thanked President Trump for the opportunity to reduce wasteful spending in a post on his social media platform on X. His effort to reduce government spending began with an ambition to cut $2 trillion that eventually downgraded to $150 billion. The Doge website currently estimates a total savings of $175. The U.S. plans to start aggressively revoking visas for Chinese students. That, according to Secretary of State Marco Rubio. The U.S. will also enhance scrutiny of all future visa applications from China and Hong Kong. Rubio said students associated with the Chinese Communist Party or studying in critical fields would be affected. Coming up, we'll have more with PIMCO President Christian Stracke on the state of the credit market. That's coming up next. You don't want to miss it on your Bloomberg Brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. Back with us, I'm pleased to say, is Christian Stracke, President and Global Head of Credit Research at PIMCO. Christian, we were talking a bit about how volatile markets have been in this moment. And in past moments of volatility in COVID, we saw funding dynamics change. That is, the banks pull back and private credit really take up this mantle. That's not really happening this time around. As you noted, the credit markets are still functioning. How do you see that mix of funding evolving this time in this volatility?
Yeah, thanks, Danny. It's a great question. There's a couple things going on. One is that we are seeing good flows into credit in general, really into fixed income in general, given the fact that equities, having recovered as much as they have, are getting back into a zone where they could be a little rich. Given that rates are quite high, we are seeing a lot of interest in high-quality fixed income. That's something that PIMCO sees and other managers are seeing. And so there is demand for liquid credit right now, and there is funding availability, particularly in the investment grade space. But you're right, there is something of a slowdown happening in corporate private credit, which had been a white-hot area of demand and of funding for the last few years. That has slowed down. It's slowed down in part because private equity itself has slowed down. If you think a lot of that corporate lending through the private credit market is there to fund private equity deals, private equity deal making has slowed down considerably, and so it's kind of a natural function of that there isn't much private credit issuance. What's interesting, though, is that there has been a significant ramp up of what's being called asset-based finance, basically private credit diversified outside of corporate lending, the traditional direct lending and private credit. So that would be non-bank lending in residential mortgages or credit cards or auto loans or aviation finance, equipment loans, things like that. That is an area that is really picking up speed in terms of the availability of finance outside of banks. So managers like PIMCO are very actively building out strategies to be able to provide financing in these areas where banks really have retreated, but where households still need access to credit. There's still a significant need for credit in residential mortgages, in credit cards, auto loans, things like that. So it's a really dynamic area where there's a transformation in the way that credit is provided into the system, and there is a lot of demand and a lot of supply there.
Just given that, Christian, is this where the next leg of growth comes from when it comes to PIMCO?
This is an area where PIMCO is actively building out, is actively finding areas where our clients are really interested in diversifying away from that more traditional private credit area or corporate private credit area. So yes, this is an area of significant growth for PIMCO. Of course, at a manager like PIMCO that's got a broad platform across public and private credit, there's a lot of growth on the public fixed income side as well. The demand for liquid fixed income with higher yields, especially given the rise in yields that we've seen this year, is significant as well. So really, if you're looking at PIMCO, there's a strong balance right now between that public and the private. But certainly out over the next few years, we do see this rise of diversified private credit, asset-based finance as one of the key drivers of growth in private credit as a whole and at PIMCO in particular.
You're talking about the spread and the private and public offerings, Christian. We are also in this moment where everybody loves to talk about the convergence of private and public assets. And that is, you get a lot of these players teaming up with the more traditional asset managers, offering things like ETFs in the case of Apollo and State Street, but more liquid-ish, let's say, products to a retail audience. PIMCO is also a firm that does span both the more private type assets and the public offerings with various ETFs and mutual funds. What do you think of that convergence? Is this an appropriate wrapper for more private credit type assets?
Well, the convergence is real, and if you look at just how the credit markets are evolving, managers like a PIMCO need to be able to provide a liquid solution to a borrower or a private credit solution to a borrower and have that option across liquid and illiquid. So that is real now, but the question, and you raise a good point, is, well, then how do investors access it? What's the right way for investors to access? There are a growing number of what are called interval funds or funds that provide less liquidity to investors for a wealth or retail audience. And those are being designed pretty thoughtfully in a way that does allow access to less liquid exposures, but conveys to the investors that you need to know that you will not have overnight access to your funds in these products. Of course, then there's really a whole question around how well are those designed, how are they structured, how are they sold, how are they communicated, et cetera. So that's a big area of development and of growth for the industry right now. But if it's done well and if it's done right, and PIMCO's got a whole suite of these products that we've been operating for a number of years now, then it can be this nice balance of access to higher returning, less liquid assets, but in a strategy that's appropriate for the investor.
Hey, Christian, this has been so fascinating. We have covered so much ground. Please come join us again. I know you're headed off to Berlin for Super Return. Hopefully I'll see you there, and safe travels on your way. Christian Stracke of PIMCO, thank you so much. Now, as we head to the end of the half-hour quick check on markets, we continue to power higher for risk assets. We're up 1.5%. A little bit of strength coming from the dollar. U.S. 10-year yields up about 4 basis points, 4.52%, just thereabouts. Now, coming up, stocks are up almost 6% since President Trump imposed global tariffs. We're going to catch up with Evercore's Julian and Emanuel next. This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Tariffs blocked. A U.S. court strikes down most of President Trump's levies
Well, we got a whole bunch of engines firing right now. The demand is just off the charts. You see the popularity of all these AI services now.
And the U.S. plans to begin aggressively revoking visas for Chinese students. Beijing bashes the decision, saying it's discriminatory. A little bit of sound issues this morning, but we are back with you. And futures are higher this morning after that court ruling. The S&P 500 futures session up 1.5%. That means just on the futures pricing, we are 4% away from all-time highs. With those Nvidia earnings in the bag, NASDAQ 100 futures also outperformed this morning, up nearly 2%. For your bond market, 30-year treasuries closed above 5% for the first time since October 2023, just 2 basis points away from the 2007 highs. We had a soft treasury auction yesterday, but maybe there's also this other concern brewing that Christian Stracke of PIMCO was just talking about. Does no tariffs mean no revenue, mean less tax cuts? As we think that one over, let's get some stocks to watch. Back with us is Bloomberg's Joe Easton. Good morning, Joe.
Hey, Danny. So it is looking like a really positive session for the chip stocks today. Nvidia up 5.8% in the pre-market following that earnings report. Now, remember, we did see the company actually beat expectations on sales. Those restrictions on goods sold into China actually not having as bad of an effect as feared, and also the Blackwell chip rollout boosting that report. And we're seeing peers gaining as well. Marvell Tech, we're up almost 7% on that one. Supermicro joining the fun as well. We're up almost 5% there. And ARM Holdings gaining as well, 4%, and adding to that move in the NASDAQ that you mentioned a moment ago. Then a sector not doing so well, potentially going to be in computer hardware. HP dropping pretty hard in the pre-market. We're down 8% on that one today. Now, the company missing on their earnings in the last quarter by a full 10 cents, really underperforming where analysts were looking on that one. HP losing out this morning in terms of your movers. Then finally, Elf Beauty, a bit of a Hailey Bieber story coming into this one. She's offloading her makeup and cosmetics business for $1 billion to Elf, which I have learned today does stand for eyes, lips and face. Elf Beauty gaining around 9%. The earnings were pretty weak on that one, but everyone focused on that Hailey Bieber deal. $1 billion that sell, the M&A focus for the cosmetics business today. Elf Beauty gaining almost 9% in the pre-market this morning. Danny.
Joe, thank you very much for that wrap-up. That is Bloomberg's Joe Easton. Now, the latest tariff ruling giving stock futures a boost this morning. Take a listen to President Trump on the market volatility and, yes, the taco trade and the headline trade.
Wall Street analysts have coined a new term called the taco trade. They're saying Trump always chickens out on your tariff threats, and that's why markets are higher this week. What's your response to that?
It's called negotiation. You mean because I reduced China from 145% that I set down to 100 and then down to another number, and because I gave the European Union a 50% tax tariff, and they called up and they said, please, let's meet right now. We have an end date of July 9th. You call that chickening out?
By the way, we should absolutely give credit to the FT and Robert Armstrong for coming up with that term, so good luck to him over there. Now, S&P 500 futures, with that gain in hand, are up now more than 5.5% since the beginning of April. We're 4% away from all-time highs. Now, the policy team and Sarah Bianchi over at Evercore writing this on the latest. Markets may rally on the news, which they are, but investors should be cautious of Trump's reaction to this and the press question, that one we were just listening to, as he still has a lot of other tariff power. Let's bring in now Julian Emanuel, Senior Managing Director of Equity, Derivatives, and Quantitative Strategy at Evercore ISI. Julian, you and the team and Sarah over at Evercore nailing it as always. So how bullish do you really want to be after this?
I think you need to be sort of step back and understand that a lot of this is sort of a game of tariff high-low, right? So at the bottom, when we saw capitulation, panic, really, and the global weighted tariff rate based on Liberation Day was well above Smoot-Hawley, 25% or thereabouts, we thought it was a good time to buy. And frankly, now here we are on the other end of it with this court ruling overnight. And the tariff rate is, implied back towards, close to what we started the year at certainly sub 5%. And we know that Trump has said many, many times how much he likes tariffs. So the ultimate landing spot is still in the middle. And to us, you've got an expensive market with a relatively high degree of uncertainty, and it's not really the time to add to risk, in our view.
Well, it's so interesting because we'd heard from a lot of business executives saying, hey, whatever the tariff rate is, just tell us what it is. Just give us some certainty. Is this good or bad for business? Because presumably he can't use the emergency powers anymore. He can still go through other venues, but that will take months to try to implement the tariffs. Months of presumably uncertainty, which businesses, again, don't like.
Well, to be clear, it may not take months to implement new tariffs. So there are certain things he can do. Section 122 is one of the things that he can refer to. But what it will, to your point, is it will keep the uncertainty uncertain. So in a way, it's good and bad because obviously the all-in tariff rate, and the market is telling you it doesn't like tariffs. So there we are. But again, Trump has been telling you for years that he does like tariffs.
Is there any sort of left tail that needs to be priced out, this idea that he can suddenly put tariffs on? Is there any repricing to be done there, or at these levels have we already kind of discounted that?
No, I think that that the market reaction overnight really speaks to, if anything, more of a lack of sellers, because frankly, active investors missed a lot of this move. The degrossing that we saw at the bottom in April was never fully regrossed, and this is a bit of a reflex move. And so the risk to the tariff level gravitating back towards that 10% baseline, or perhaps higher when you think about China, is definitely there. And it's like you're going to hear more about it probably in the next couple of days.
So this idea of, hey, maybe we dust off the playbook we had before this, of American exceptionalism, of inflation starting to wane, of the Fed's cutting, we get back to normal programming, too soon to do that?
Well, except for there is one part of that playbook that really makes a lot of sense to us. We have been, huge proponents of AI-driven stocks and themes, really the way forward. They led the bull market into this peak in February. They were the worst hit stocks during the downturn. They have led since April 7th. That's where we want investors to concentrate their exposures.
Oh, I'm so glad you brought this up, because we did get Nvidia earnings yesterday.
Oh, that.
And I think you and I both expected that that's probably what we would be talking about this morning, if not for that. Did that help reinvigorate that?
Oh,
Does that
no
give you the
question.
confidence that the next leg is led by AI?
No question. And because the thing is, when you look at their results, it wasn't entirely intuitive that the stock was going to rally, and that was before we got the tariff news. But investors stepped back, and what they saw was anything that was caused by a shortfall due to restrictions on sales to China was made up elsewhere. And that speaks to the power of the AI revolution. And when you think about how those stocks have traded the last 6 months sort of sideways for the most part, while earnings continue to grow, it remains a secular growth story that we and our collaborators at your old alma mater, University of Virginia, have done a lot of work on, and we think it's a theme that's worth concentrating on.
My favorite collaboration of 2025, without a doubt. You know I love that, Julian. So if tech leads the next leg higher, let's talk about the other end of the market, and that is small cap, still about 16% away from all-time highs, whereas the large cap is about 4%. What needs to happen to revive that trade?
So from our point of view, small caps are sort of in the so bad it's good category. Is that basically they've been left behind for the most part, because if you think about smaller companies, they are price takers, not price makers. So the fact is that tariffs are more punitive in an environment where the labor market has really only started to begin to loosen up. And of course, yields have been a headwind. But from where we see it is that all of this in aggregate takes away the probability, that left tail of a recession. It's always been our base case. The market is coming around to that, and that in and of itself means the credit markets stay open, which is another thing that is beneficial for small caps.
Julian, what a morning. Thank you so much for joining. It's so wonderful to try to navigate it with you. Julian Emanuel of Evercore ISI. All right, let's get you some of the top stories that are trending on the terminal this morning. As we've been discussing, a major blow to President Trump's trade agenda. The U.S. Court of International Trade has ruled that the president's global tariffs are illegal. It said the administration wrongly invoked a 1977 law in imposing his, quote, Liberation Day tariffs. The administration said it will file an appeal. The U.S. plans to aggressively revoke visas for Chinese students with connections to the Chinese Communist Party or studying in critical fields. That's according to Secretary of State Marco Rubio. The U.S. will also enhance scrutiny of all future visa applicants from China and Hong Kong. And Elon Musk's time as a special government employee has come to an end. In a post on X, Musk thanked President Trump for the opportunity to reduce wasteful spending. His effort to reduce government spending began with an ambition of cutting $2 trillion, and before that, downgrading to $1 trillion and then $150 billion. Coming up, we do get to talk more about Nvidia. A sigh of relief. Julian Emanuel was just discussing the AI trade. We're going to get even more from HSBC's Frank Lee, who's called the numbers good enough. Hey, we'll take it. That's next on your Bloomberg Brief.
The Chinese competitors have evolved and advanced greatly over the last year. Like everybody else, they're doubling, quadrupling their capabilities every year, and the volume is increasing substantially. And remember, these are data center chips. They don't have to be small; they could be quite large. Without American technology, the availability of Chinese technology will fail the market.
Nvidia extending gains in the pre-market after it eased concerns of a China slowdown, saying that the AI computing market is still looking at exponential growth. Joining us to walk through the numbers is Matt Bloxham of Bloomberg Intelligence. Matt, what was the takeaway?
Yeah, I think a relief surprise for the markets, resilient revenue in the quarter. And I think even though probably the China headwinds are blowing stronger than people thought, so about 8 billion of sales headwinds in the Q2 that's going to come. I think the market was looking for about 5 billion, but despite that, the guidance range for Q2 sales, which midpoint's about 45 billion, in line with where consensus is, and the gross margin also in line at kind of around 71-72%. So I think that was reassuring, and underpins what you were just talking about with your previous guest, that the AI story is still very much a structural growth story, and there's huge amounts of demand outside of China to kind of make up for that headwind they're facing there.
What about on China? Because this had been really the big concern of what did China sales look like? Can they get back into this market? What replaces it? What did we hear from Nvidia?
Yeah, I mean, I think certainly in the short term, the ability to get back into that market looks very, very low, and it may even be that they're closed out of it permanently. Obviously, depends a lot on what the US administration decides to do about restrictions there, because they don't have anywhere to go with the existing H20 chip to kind of depower that anymore. He did talk on the call about some other options they're looking at, but we'll have to wait and see whether they play out. And I think importantly, what he said was that Huawei's capability matches already the H200 chip, which isn't far off Nvidia's kind of leading edge offering. So I think it's going to be very hard for Nvidia to compete in the Chinese market from here unless all restrictions were taken off by the US administration. I think that looks incredibly unlikely, and we've also heard that there are restrictions on AI software going into China too. So that just, I think, adds to the complexity of doing business in that market. And for me, the kind of risk is, as someone like Huawei gets more momentum, they potentially become a more significant competitor to Nvidia in markets outside of China. So that if I was running Nvidia, I'd definitely be concerned about that and making sure that I was looking down as much share and business as I could outside of China to keep that moat high.
Matt, really appreciate it. That is Matt Bloxham of Bloomberg Intelligence. I'm pleased to say joining us for more on Nvidia is Frank Lee, Global Head of Tech Hardware and Semiconductor Research at HSBC, who has a hold rating on the stock. He has raised his price target to 125 from 120 post earnings. Frank, great to see you this morning. I got to say, I love this in your note. No beat and raise, but good enough to avoid disappointment. How good is good enough?
Yeah, so I think what's different is that if you look at the numbers themselves, they're not noticeably different than the last couple of quarters. They just met numbers and I think the overall consensus. But what's different was I think going into this quarter, there was a lot more fear and concerns that they would miss the uncertainty around the loss of the China business, as your previous guest just said. And I think they met it. They met the numbers. And I think people walked away feeling much more at ease that that was going to be the case, that there wasn't going to be much of a downfall from the back of that. They did recognize that they're going to lose about almost something like 15 billion in revenues in the first half alone because of the loss of the H20. But that being said, I think they gave some reassurances that their Blackwell ramp will continue to improve, which we do expect is the case. So I think that was good enough for the market to feel somewhat at ease.
Frank, did you and do you see a path for Nvidia to seriously get back into Chinese markets?
Yeah, so I think contrary to some of the market belief, we actually do expect that they will be looking to get back into the China market. We have started to see some signs in the supply chain that there is another AI GPU Nvidia is targeting potentially for China market that will meet all the U.S. restrictions. Potentially, they will be taking out the high band memory and using a more lower end memory spec to get back into China market. We think that could help claw back some of the revenue loss from H20. It won't make up for all of it, but I think there's a sense of urgency, as you can see from Jensen's comments, that he wants to be back in the China market.
Yeah, absolutely. And I also saw this in their 10Q, which I thought was pretty interesting yesterday, Frank. This is what they wrote, that regulators in China are investigating whether complying with applicable U.S. export controls discriminates unfairly against customers in the China market, going on to say that if they were found in violation of that, they could be subject to financial penalties, restrictions on our ability to conduct our business. Is there a real risk that Nvidia not just gets hit from U.S. regulators, but that it becomes this political hot potato, and China also imposes some regulations, some financial liabilities too?
Yeah, I mean, I think that that's a concern that has been out in the market. But the way we look at it is that Nvidia still offers the best and most competitive solution today. And I think if you look at Jensen, he has been quite vocal about support of the China market. In fact, he went to China as soon as the H20 restrictions were announced. So I think he has shown that he is quite committed to try to work with both sides in order to make something work here.
Yeah, I mean, he's been quite vocal about not just that, but also to your point to the U.S. saying that China's got ahead of us in AI and we need to do something about it. Frank, at the same time, I know before the earnings, when you had joined Bloomberg TV, you had talked about some of your concerns, the China ban coming earlier being one of it, but the ongoing supply chain issues being another area of concern for you as well. Did Nvidia do enough to address that in your mind?
So I think there's been interesting debate, especially for investors in Asia who's closer to supply chain. We continue to see a gap difference between what's happening on the downstream ODM assembly level versus what has been able to ship on the upstream. Now, Nvidia has talked about improvement. The rack numbers are continuing to improve, but we still think there will be some sort of a gap that still needs to be monitored. So I think that's going to be one of the things that we will watch very carefully. We do think that they're not 100% out of the woods yet in terms of the supply chain issues.
One of the other things we learned was just this massive cash pile that they've been building, $53.7 billion. That's up from $31.4 billion a year ago. Frank, we've seen them have a lack of opportunities when it comes to big deals. What would you like to see them do with that cash? Should we start clamoring for increased payouts in the form of bigger dividends, stock buybacks? What happens to that cash pile?
Yeah, it's a good question. I think, some of these companies have started to talk about buybacks. Nvidia hasn't really yet. I think that's an option that they could do. They are really printing money right now, and so I think that's going to be one of the options that's available to them, is just to how much to give back to investors from a dividend point of view. Could they do buybacks? These are all possibilities, right? And I think they're in a good position now because there's not a lot of cash outlay that they need to put out, and so I think so far business has been strong. So I think that's something the management can consider as well.
Frank, thank you so much for joining us. We really appreciate it. Your voice is one of our favorites here on Nvidia, Frank Lee of HSBC. Now, coming up, we're going to get you set up for your trading day. We got some Fed speak, retail earnings, all on deck. We'll catch you up on what to expect on your Bloomberg Brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day today. We're going to have more retail earnings. Best Buy, Kohl's, Bath & Body Works, all of that will come before the bell this morning. Then core PCE, personal consumption, and jobless claims data. That comes at 8:30 a.m. Eastern. And we're going to get Fed speak throughout the day. Barkin, Goolsby, Kugler, Daly, and Logan. Now, for your movers this morning, Nvidia, that is extending the post-earnings gains. That's leading chip sticks higher. We're just hearing from Frank Lee of HSBC that it was good enough to allay market concerns. Cadence Design Systems up 5.2%. It is rallying. It closed down 11% yesterday after reports that the Trump administration is ramping up China chip curbs, maybe with some court powers being instilled over tariffs. That's making us rethink what happens to the chip curbs. Finally, HP, those shares down nearly 8%. It plunged after cutting its profit outlook on tariff concerns. But how much are companies now going to have to readjust yet again their outlooks if the version of Trump tariffs that Trump has put in needs to be re-examined? Well, in the meantime, we are buying now and asking questions later. S&P 500 futures are up more than 1% this morning. In fact, up nearly 1.5%. Not a huge rally, all things considered. The dollar is somewhat stronger. We have seen weaker dollars. Does this make us want to go back into U.S. assets? But maybe not duration. 10-year yields still down more than 5 basis points this morning. It's interesting. The first initial reaction has been concern again on the fiscal front. Does this mean less tax cuts if we don't get tariff revenues? All right, that is it for your brief. Surveillance will take you through a busy morning from here.